Hi, so in the previous video we added investment into our model and we looked at how certain changes in parameters can affect investment. Now we're going to generalize more to the goods market equilibrium as a whole and see what happens when we have permanent and temporary shocks to productivity in the goods market. So to start off with, what we need is our aggregate supply and aggregate demand relationships in the goods market, and we've derived these in previous videos. I shall not go through deriving all of this again, so I will link the previous videos so that you can check this out, or just check out the playlist, it's all in there. But we have an aggregate supply relationship which depends of course on our productivity parameter A1 and the interest rate, and it depends on both of these positively. If we increase either of these variables, we're going to increase aggregate supply. I've explained this previously, so I won't use up time doing that again. We also have a what we set equal in equilibrium is we set this supply relation equal to our aggregate demand function, and in the previous video, we said what this aggregate demand function was. It's consumption plus investment. So let's first consider our consumption function, which we have here. And we know that this depends on the interest rate as well. And it depends on our present value of income, which we write as y. And we have also found how these factor into these equations. So if we have a higher interest rate, we have lower consumption demand in period 1, and if we increase our present value of income, we are going to increase our consumption in period 1 as well, so that factors in positively. And for the rest of aggregate demand, we in the previous video added in investment demand, and what we saw in that video is that this depends on our productivity parameter A2, so it depends on productivity in period 2, as we had this time to build model, and it also depended on the interest rate. We also found that it depended on the depreciation rate, but this was indeterminate, the exact relationship, and we're only looking at productivity shocks in this video, so we'll just leave out the depreciation term here just to keep it simple. We know that investment demand depends negatively on the interest rate R, and it depends positively on future productivity. We're going to invest more if we think productivity in the future is higher. So that is our aggregate demand and aggregate supply relationship, and they're equal in goods market equilibrium. Why have I written all this out and spent lots of time going over what these terms are? Well, it makes doing our diagrams and looking at the impact of a productivity shock a lot easier. If we can write out our functions in this form, then it is a lot easier to think what happens when we change any of these parameters, because we see their relationship in these functions. So say if we increase productivity A1, then we can directly see what's going to happen to our supply and our demand functions. So let's get into it, and the way we are going to see how shifts or shocks to productivity enter into our model is we're going to again graph these functions out. And so the other useful thing is the fact that we have interest rate in all three of these functions we have here. So when we draw these graphs in interest rate space, or we have interest rate on the y-axis, we know the slopes of each of these curves, and it's given by the way interest rate affects each of these functions. And so a change in interest rate isn't going to shift any of these functions. It is going to determine the slope, because our y-axis is given by the interest rate and our x-axis is given by our output or just our output. So let's draw our aggregate supply curve. I'm going to make this slightly thinner because we're going to have lots of curves on here. So we'll call this our aggregate supply curve, y1s. and we have an aggregate demand curve which depends negatively on the interest rate, so that is downward sloping y1d. Now, why have I drawn this like this? We'll quickly just show what our equilibrium is when these two are equal, y star and r star. Well, I've drawn the demand curve with all the way over to the right, because what we're going to do here is we're going to split it into its component parts. So this y, or demand curve, depends on our investment curve, which is over here, investment demand in period 1, and it also depends on our consumption function, which will draw something like this. And as we can see above in the equation, we see that y1 equals c1 plus i1. So at each point, if we add up, if we're, say, here, we add up these two curves, so that plus that equals this point here, and so the demand curve is the sum of the consumption and the investment curves. So we have split the demand curve into its component parts there. Why have we done that? Well, we can now, when we have a productivity shock, we can see what the impact is on the consumption curve and on the investment curve, and then we can sum up these effects, add them together to see what the effect on our demand curve is. So let's get into it, and let's first consider a permanent productivity shock in this model. So what does a permanent productivity shock do? It increases our A1 and it also increases our A2, and it increases these by the same amount. So our increase in A1 is equal to our increase in A2. So check out, you should have watched, or I hope you've watched, the video where we did shocks to productivity where we didn't have investment in the model, and a lot of this is going to be very similar in this video, but we now have an additional effect on how this change in productivity affects investment. But our initial shift, what colour should I draw this in? Let's draw these shifts in red. And so the initial shift is to shift our supply curve out to the right. So this is y1s1. And why is this? This is because we have increased A1. And if we look at our supply curve relation in the top left of the screen, we see that this depends positively on A1. If we increase our productivity, we're going to increase our supply instantly in period 1, because every unit of input creates more output, so this increases our supply. We talked about this in a previous video, so I won't get in too much more detail, but this shifts out our supply curve when we have a permanent increase in productivity. Okay. But now we have, beyond this, we have an indirect effect on consumption. And again, we discussed this in a previous video, and it says, and we use the wage first order condition, which I won't write out again, but by increasing productivity in period 1, we are increasing the marginal product to labour, and marginal product to labour in equilibrium is equal to our wage rate. So by increasing productivity, we are indirectly increasing our wages, and so we are increasing the present value of income, which, as we can see in our consumption function here, factors in positively. So our indirect effect here is that we shift the consumption function a little bit to the right. So we move to C1 D1. So we've shifted demand and we've shifted consumption, and this is going to get very messy on the diagram, so I apologise for that, but I'll try and make it a bit clearer as we go along. But by shifting the consumption function to the right, this means we also shift our demand function to the right, to y1 d1. This is because, as I said before, this demand curve is the sum of the consumption and investment curves, so by shifting consumption to the right, we also shift demand curve to the right, because as you see at the top of the screen, this Y1 demand curve is equal to consumption plus investment. So if we increase consumption, we're going to have to increase our overall demand function. Okay, so we've shifted supply, we've shifted consumption, and we have a third and final effect, another indirect effect on our investment curve. And this is what is different from the previous video, is that we shift investment out because we have a permanent increase in productivity. So we increase our A2 parameter, our productivity in period 2. So what this means is that, as we can see, this factors in positively into our investment demand equation. We see that future productivity is going to rise, so we want to invest more. This makes sense because we see that future units of capital produce more output than they previously did, so we are incentivized to invest more right now. So in period 2, we can, after we've used our time to build, we then have a higher capital stock in period 2, and then this will produce more productively. So our final effect is that we have a shift in the investment curve. And what we tend to do is have this as a very big relative shift in investment. And this is how we factor in to our model the fact that we often have, or empirical results show that large quantities of, or normally business cycle fluctuations come largely down to changes in investment. So I've shifted this investment curve quite a long way, or a lot further than I shifted the consumption curve, to show that this is a large increase in investment coming from this increase in productivity. And as I said with the consumption curve, by shifting the investment curve, we have to shift the demand curve again out to the right. And there are an awful lot of curves on this diagram, but we shift to Y1 demand 2. Now I am going to go over this in green to show where we have ended up. So what we did was we shifted the supply curve to this supply curve 2. Actually, let's get a thick pen. Hopefully this will make sense. So we shifted to this curve. This is not going to be a straight curve. I'm awful with this pen. But okay. We end up at this Y1S2. I'll write that in green. And we ended up at this Y1 demand 2. So this is our new equilibrium point, and let's show where that ends up. We end up at Y star 1 and R star 1. Nice thick pen there, making it very difficult to write. But okay, what we see here then is that we have an increase in interest rate and an increase in output due to a permanent increase in productivity. So this is different from the previous model where we said a permanent increase in productivity would not have a change in the interest rate because we aren't changing intertemporal decisions in the economy, because we only looked at consumption. And because there was a permanent increase in both periods, we didn't have any reason to change our interest rate. But this has changed now that we've added investment, because investment does not care that it doesn't care that we've increased in both A1 and A2 productivity, because as we see from the investment function, we only care about A2 productivity. So our consumption functions shifted in much the same way as in the previous video, but now we've added on an investment effect from our productivity in the future increasing. So we now increase our interest rate to reach equilibrium in the goods market. Okay, so now that we have looked at the permanent effects of a productivity shock, or the effects of a permanent productivity shock, let's look at the effects of a temporary productivity shock. Temporary. So what is a temporary productivity shock? It says that we increase productivity in period 1, A1, but we keep productivity in period 2 the same. So A1 increases, A2 does not change. So again, we will analyze this in a similar way to what we did in the previous video. If we increase A1, this factors into our aggregate supply function positively, as we can see. So we're going to shift our aggregate supply relation out to the right to Y1, S1. I won't explain why, we just showed that in the previous example, or in the permanent productivity shock. So now our second effect is going to be an indirect effect, and again, very similar to the previous example, by increasing productivity in period 1, we increase our marginal product for labour in period 1, which increases our wage in period 1, which increases in turn our present value of income. So that factors into the consumption function for period 1. Now this is a slightly smaller shift in consumption than we had in the previous one, because in this one we increase wage 1, but wage 2 stays the same because productivity in period 2 has stayed the same, whereas with a permanent shock we increased both wage 1 and wage 2 because we increased productivity in both periods. But okay, we are increasing wage 1, so we increase our present value of consumption a little bit. So we shift this consumption curve to the right to C1 D1. And we know shifting the consumption curve means we have to shift the demand curve by an equal amount. So we shift demand to the right by a little amount. Okay, so we have shifted our consumption curve and our supply curve, and we have a third and final effect, and this one is the difference between permanent and temporary, because this change is a second shift out in supply. And can you spot what this increase in supply comes from? Well, it was here all along. It's the fact that we have increased W1 and kept W2 the same. So this means that we increase the ratio of wages from period 1 to period 2, and as such we then have individuals substituting labour from period 1 into period 2. So we increase our supply of labour, which increases our output, or our supply function. And we showed this in the previous video where we looked at a temporary productivity shock. So I won't go over deriving all of this and showing the algebra of it, so check out that video for that. But the fact of the matter is we have a second shift in our supply function. It is an indirect shift in supply again. And that is it. That is our final equilibrium. So I will get a nice bold pen and we'll do this one in blue. Luckily there aren't as many curves on this diagram as the previous one, but I will show where we end up. We end up at this supply curve, which is shifted twice, one direct because of the increase in A1 and one indirect because of the change in the ratio of wages, and we end up at this demand curve. So our new equilibrium we can do in black is at this point. Probably shouldn't have done that in black, but oh well. I'll get rid of the axis label. So we end up at y star 1, and we end up at r star 1. So as we can see, the overall effect is to decrease the interest rate and to increase the output in period 1. What do we notice that is quite a big difference in this example to the permanent shock example? Is that investment is completely unchanged. So we've added investment to the model, but it doesn't factor in with a temporary increase, because investment is only concerned with future productivity. We invest today to reap the benefits in the future, and if our productivity doesn't increase in the future, well, investment isn't going to increase, so this investment curve does not move. Now, so that's the difference between temporary and permanent productivity shocks. I'm going to add a quick aside here, though, something that I maybe should have done in the previous diagram, but as we see on this black line dictating where our equilibrium ends up. Here, if we look at what our interest rate is, we can actually use this with our investment and consumption curves. So we can see that we have this new interest rate R1 star, and at this interest rate we can now figure out how much consumption we have and how much investment we have at this interest rate, and we can actually now draw a line down from those to say that our consumption in the economy is this C star and our investment in the economy is I star. And with any luck, it actually looks roughly to be the case, not quite. We should have that this Y1 star is equal to C, let's subscript these with ones, is equal to C1 star plus I1 star. And so by doing this exercise where we see what the consumption and investment is at the interest rate, we can just decompose the aggregate demand into these components, and we can also say that, okay, we originally had consumption given by this curve, and we can see that our consumption has increased by this distance here, and our investment hasn't changed at all. And in the previous diagram, we could have shown that investment increased a lot and consumption didn't increase very much. And the other thing to highlight here is that although we've had a shift in the consumption curve, by decreasing the interest rate, we've actually also had a movement along the consumption curve. So consumption has increased an extra amount. If we had, say, we were originally at this interest rate, if you can see where I'm doing this dot, let's do it in blue. We were originally at this interest rate, and so on the consumption curve we had this level of consumption. So actually, yeah, what I just said was a little less accurate. Our increase in consumption is actually a larger area than this. It's given by this blue interval. So we originally had this interest rate and this consumption curve. So we originally had this much consumption. By shifting the consumption curve, we moved to this new second blue dot, which is roughly equal to that C star 2. And then by the fact that we have decreased the interest rate R, we have then moved along this consumption curve to the final point C1 star. So sorry if this hasn't been very obvious on the diagram because it's very messy, but do note that we have shifted the consumption curve and we've also moved along the consumption curve because we have changed the interest rate in equilibrium. So this just about wraps up the video. Check out the playlist for future videos on this topic. I will be looking at government in this model and adding government into the intertemporal model. Subscribe for future videos and please do drop a like rating if this was at all useful.